Hello, and welcome to the Invest with Carl podcast. This podcast will bring you, obviously, everything about Carl Investments, discussions about new features and strategies being launched, as well as commentary on general alternative investments news, slanting towards quantitative perspectives and the general democratization of sophisticated investments. Or said simply, bringing high-quality, sophisticated investments to all investors. We're looking forward to the conversation, so let's get started. Hello, I'm Jamie Eppenberg, your host today and a member of the Carl team. We're chatting with Joel Murang from Cazadores with their Quantitative Hedge Fund. We're going to find out today what makes the fund successful, as we always do, and we'll get a little history and what's important for investors to know about this fund. As a reminder, we are Carl, digitally offering quantitative hedge fund strategies as funds of funds, packaged and data-driven delivery to accredited investors. Carl is offering Kilimanjaro, which is based on Cazadores Commodity Alpha Fund. Joel Murang has been trading in the commodities markets for the past 10 years, firstly in Asia at a large investment bank, and now in the UK at a hedge fund. His strategy is very exciting in that it trades across all the commodity markets, including well-known ones such as gold, natural gas, and soybeans. And we know at Carl, many of you have been asking for diversification options, and commodities is a market that there has been a lot of interest in having on the platform. So hi, Joel. It's great to be chatting with you today. How are you?
Hi, Jamie. I'm good.
Great. So we always kick off our new investments with you telling us what has made Kilimanjaro or what has made the Cazadores Commodity Alpha that Kilimanjaro is based on successful so far. Like, why do you keep it in your portfolio aside from the fact that you manage it?
Sure. So the Commodity Alpha program is a long-short commodity trading strategy, and it tries to capture price disruptions in the commodity and supply and demand imbalance. So during the coronavirus pandemic of 2020, this disruption was very apparent. For example, oil prices went negative. And one of the reasons that I keep it in my portfolio is that given the unprecedented central bank easing at the moment, stocks are out at all-time high, bond yields are extremely low, commodity markets seem to be a natural place to look at. And commodity prices aren't dictated by one large central organization. They're driven by things that happen in the real world.
Right. So those drivers in the real world, is that something that you are focused on regularly? Is that part of managing the fund?
We don't look at those drivers explicitly, but those drivers have an impact on price. And what we try to do within the commodity program is we try and capture those drivers as they affect the price information.
Because you're trying to capture variances or what you expect to be movements in the commodity prices. Is that correct?
Yeah, that's right. So maybe I'll give an example to speak through, I guess makes it a bit more concrete. So if you think about a commodity market that's in equilibrium, that means supply and demand match and transactions occur quite seamlessly. So at some point, a disruption may occur. And typically the disruption, if we think of a farmer, the disruption will occur on the supply side. So there might be a storm, for example, that damages his crops. This will send prices higher because there's now a disruption in the equilibrium. And as the prices move higher, they're trying to find a new equilibrium level to trade at. And this is when you get what market participants call a trend occurring. So you would typically try to get onto this trend as the market searches for a new equilibrium price. Now, at some point, the price of his crop, for example, if it's soybeans, might go far too high, and the consumer of the soybeans no longer wants to pay that much for it. So a couple of things could happen. The consumer could look at another crop. So instead of looking at soybeans, he might use corn in his chicken feed. Or you might find that other farmers who had a lot of that corn might bring it onto the market. So then what happens is now that the price is shot past this equilibrium level, it will mean revert lower to a new equilibrium level. So that's what we're trying to do. We're trying to capture these price movements through trend and mean reversion and equilibrium levels.
And you're doing that. I mean, you're not specifically looking at these. You're using quantitative analysis to analyze when these shifts in commodity prices are taking place.
Yes, exactly.
And you don't care which commodity. That's why at the beginning you're like, it's really across all the commodities, right?
Yes, that's right. And I guess that's the beauty of the strategy. All commodities tend to be driven by the same, economics 101, supply and demand. It could be corn, it could be, gas oil, it could be, copper.
Yeah, that's what it sounded like to me when you said it. It's kind of simple economics, but because you're searching for the opportunity through quantitative analysis, you're finding it hopefully faster than most, and knowing when to step out when that is going to be over.
Yeah, that's right. And I guess where we're slightly different is, I guess, how we're different from, say, a typical trend follower. A trend follower is someone who jumps on a trend whenever they see it occurring, whereas in our case, we don't think that every price movement in a commodity is going to result in a trend, for example. So we're trying to look for those, really, really big trends that occur. And when those really big trends that occur happen, we're not trying to stay in it as long as possible. We're trying to get out of it once we think the trend has died. And in fact, we might even go the other direction and try and short it.
Right. So you're seeing the trend and knowing it's protect the capital time. Okay, so as Kilimanjaro, it seems as Kilimanjaro management, you really care about commodities, the prices of commodities, and the data, historical data that feeds that pricing, and feeds future movements within that market. So, was this the plan from the beginning, or has the strategy changed from how it was originally imagined?
So I started trading this strategy in 2018 at a large investment bank on the proprietary trading desk. And the signals that we use now in the program are largely the same. How it's changed slightly is that we've been able to increase the commodity investment universe that we trade. So we can now trade more commodities and more contracts. And I guess to your point earlier, not only is trading commodities bringing in diversification, within the commodity space, we're trying to diversify even more. So while the strategy hasn't changed fundamentally, it is different because the investment universe is much larger.
Great. So it sounds like the strategy itself at the core. I mean, we said this just a moment ago. It's a relatively simple concept, but it's using a ton of data, right, to capture that before most and be able to step on and off appropriately. You've been able to expand it into more commodities themselves, commodity markets. So then, and it's working. I mean, if people look at the history of Casadora's commodity alpha that Kilimanjaro is going to be based on, a lot of success there. And I think that's why people are interested in diversifying into commodities and then being able to have a fund that is has this kind of history with it, even though obviously history is not an indicator of future performance. Regulators, I will make sure that is said. At the same time, we have a lot of focus on your fund, and the past few years have really brought an investments digital revolution. So investments are looking at digital. This is a quantitative fund. Using technology to make investments available to more people is also something that's happening within that revolution. And we've seen this, and our podcast listeners hear me talk about this all the time. We've got Robinhood and Yield Street and Fundrise. And now we have Carl, which our focus is on the quantitative hedge funds. We think that those are quality investments to be moving in this space. What do you think about the changes overall within the investment space as far as digital and technology have impacted that space, and specifically within quantitative hedge funds?
Yeah, it's a great time to be in the space at the moment. I think someone said before, the only things certain in life are death and taxes. And within the investment space, the only two things that are certain are investment costs or transaction costs are real, and diversification improves returns. So, with the rise of more digital focused platforms, it's going to bring down investment costs, which is great for traders, myself included. And it also brings about more opportunities for people to invest in different things. So that improves the diversification aspect. of one's portfolio. So overall, it's a great movement and specifically for quantitative hedge fund managers, such as Carl, the great thing is quantitative hedge fund managers, they trade many, many different things at different points in time. Sometimes they're long, sometimes they're short in different sizes. And because they're doing all these different things, they create a unique return stream. So the strategies that you'll find on Carl are going to be completely different to and have completely different return profiles to whatever you can find in the stock market, mutual funds, or even the crypto space. So I personally am quite excited by it because by combining these different strategies from a quantitative hedge fund, you're going to automatically increase your returns through diversification benefits.
Yeah, that's a huge conversation over here. I mean, we've had a lot of investors not only move portions of what's historically the 20% alternative investments portion of portfolios, which is where a lot of people see hedge funds existing. But I'll ask you this. I don't know if you have a perspective on it or not, but we have investors who are actually looking at the bond portion of their portfolio, and they're looking at Carl funds, quantitative hedge funds, because it's taking off some of the downturns. It's taking the edge off the downturns with some of these strategies while still providing quite a strong return, whereas the bonds are getting a little not as dependable as they used to be. Do you have a perspective on that?
Yeah, I mean, I think it's a really great idea. I think you're not really getting much return on your capital if you're investing just on the fixed income side. And I think what we see a lot of fixed income managers doing is they're moving further down the credit curve to generate the same returns that they used to. So, while a couple of years ago your risk-free rate was 5% on investing in government bonds, to now get 5%, you need to look at much, much riskier corporate debt. So it makes sense to think that you should move out of fixed income and sort of diversify away from that. Besides the diversification aspect, I think bonds now, or the bond story is like one of the big drivers in the market at the moment.
Yeah.
The big concern being inflation. And if inflation starts to take off, bond prices are going to go down. And, I guess one, quantitative hedge fund strategies should be relatively immune to inflation because they're not outright directional. And I guess the second aspect is that if inflation, becomes more prevalent, you do want to kind of look at real assets such as commodities and real estate to sort of diversify out of it. So I think, that's a wise move. I think fixed income is definitely going to be, the selling off of fixed income in 2021 is going to be the big story this year.
Yeah, for sure. And what people end up investing in instead, I think there'll be a lot of story there. Is it stable? And that's what we're looking at Carl. Can we provide, stable funds that it's not that they have no downturn. Every fund has its ups and downs, but can they take the edge off the down? Is a big conversation. I think it'll be interesting. People, where they move that money is going to be part of the story as well. Did where they move it perform? And I think Kilimanjaro is a place that people could look at by taking the edge off of the downturns. And it's not that funds don't ever go down, right? That's not the idea. But will it perform better than indexes or other investment opportunities they have to move that money? I think this is something they could look at. So we know that we have a lot of digital and technology, while at the end of the day, it's always about performance and risk controls, right? And we will surely have a risk conversation. We'll have a risk part of our risk series. We talk to all our funds about risk. So we're enabling investors to have more access to fund performance, and they can basically review more information than ever before. As investors watch Kilimanjaro, what would you say is something that they could feel really good about? Or to say it another way, what does Kilimanjaro do really well?
I think, so there are two things I think about when I think about what we do well. The first one is providing low to no correlation. So we're uncorrelated to equities, we're uncorrelated to fixed income, but more interestingly, we're uncorrelated to the commodity asset class as a whole. And even within the commodity asset class, we're uncorrelated to other commodity hedge fund managers. So that's one thing that we do really well in. And I think, just by adding our portfolio to your, a broader investment portfolio, you will see the gains improve by bringing down risk and increasing performance. The other thing that I think we do quite well at is looking for what we call sustainable alpha. We try and find quantitative trading signals that will continue to last over the next 5, 10, 20 years. And, we're not looking for those trading signals that, will last for, 1 year or 6 months and then, suffer from alpha decay. We're trying to look for something that will continue to provide returns. And the reason that we can say that is because we're looking for things that are moving and changing in the physical world that aren't so easily arbitraged away.
Excellent. Thank you so much for that. Very interesting. It'll be a great fund to watch. Thank you so much for chatting. And we always end on, what would be your final words for Kilimanjaro investors?
So as final word to Kilimanjaro investors, I guess I would say that we at Cazadores are going to continue to work hard to generate returns. We're always on the lookout on ways that we can improve and generate alpha. We work tirelessly so that you don't have to.
We know that at Carl. I'm sure part of our due diligence, we reviewed your research and development, which you've talked quite a bit about, which is you're always looking for the next alpha. Thank you so much, Joel. It's wonderful to talk with you. Thank you so much. Investors, thank you for joining us for another episode of Invest with Carl, and we will see you next time. Bye-bye now.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.